I guess as human beings, human beings are fallible, and I'm all too human. So, even to this day, I'm constantly sort of checking myself in terms of what I know to be the solid principles that have worked. But I have to remind myself constantly. And that's probably for me, one of the benefits of writing the Global Investment Letter is that, it helps me. And I've even occasionally written that in the issues. I say, I'm reminding the reader, but I'm also reminding myself that you got to bear this in mind and so on. And so, so the global, the newsletter is a bit of a sort of a check on myself. And I think I'm probably a better investor for writing it than if I did.
Welcome to the Alpha Mind podcast with me, Stephen Goldstein, and my co-host, Mark Randall. In today's podcast, we had the pleasure of chatting with Jonathan Baird, an award-winning money manager and investor of almost 4 decades who publishes an outstanding monthly newsletter, the Global Investment Letter. Jonathan shares fascinating thoughts and perspectives on the investment process, his journey and career, the emotional and psychological challenges of investing and managing money, and how putting his thoughts down in a journal both helped his investment process and his personal estate management and evolved over time into the brilliant Global Investment Letter. Before we start, a few words about our sponsor, the Society of Technical Analysts, the STA, and their brilliant Technical Analysis Home Study course. The Home Study course is an online version of the full programme which is taught at the London School of Economics. If you are keen to develop your technical analysis skills and take your knowledge and understanding of them to the very highest level, then this is the programme you should be considering. As one of the lecturers on the full programme, I am fully aware of the high quality of the Home Study course, which has been written in partnership with many leading figures from the world of technical analysis. And since the STA is a not-for-profit body with a history going back over 50 years, you can be certain their only agenda is your education, development and growth. We are delighted to announce that the STA are offering a discount on the full cost of the Home Study course and the Home Study course and Diploma Programme to listeners of the Alpha Mind podcast. To find out more about the Home Study course and how to get the exclusive Alpha Mind discount, visit the Alpha Mind blog page where you will find a link to the Home Study course at the top of the page. Go to alphamindblog.blogspot.com or just Google Alpha Mind blog. Now on with this week's podcast.
Welcome to this week's Alpha Mind podcast, and we have Jonathan Baird with us. Jonathan is the editor and publisher of the Global Investment Letter, and spent more than 25 years as an award-winning money manager in Canada, and most recently winning a Lipper Award in 2010 for managing the #1 global equity fund in Canada itself. He's run several top quality #1 ranked funds over the course of his career as a money manager. And of course, this has led him into investing in all major industries, asset classes and markets, which I'm sure our listenership will be very interested in. But of course, it's his driver behind this newsletter. It's what links to the world of Alpha Mind is philosophy behind it, the sort of psychology behind some of the investing things he gets involved with that we're looking to tease out of this conversation today. And he understands the difficulty of the investment process and the essential role that quality information and opinion play in successful investing. So, Jonathan, welcome to the show.
Thank you very much. It's certainly my pleasure to be here.
And perhaps I gave a brief introduction there, but tell us more about your journey so far and perhaps start to lead into some of the themes that we know are important for the audience.
Yeah. Well, you certainly summed up my career actually very nicely. I guess from the point of view of our discussion today, one of the things that springs to mind for me is how dramatic the evolution of my style has been over the years. When I started managing money in the mid-1980s, I was a dyed-in-the-wool Ben Graham aficionado, very deep value. And I would be I literally were buying companies below their net working capital. You could do that in those days. It's much more difficult now. And I started managing money. I started in the business in late 1984. And then I was actually sent over for about 7 months to London to work with the company I was with, London office, which was a wonderful experience. And I came back at the end of 1986 from that and was given my first little bit of money to run. So I started managing money quite early in my career. And so I was managing money for about 9 months before the 1987 crash. And so I have some vivid memories of that. And then after that, I managed, luckily, the value of approach that I was using actually held up very well through the crash and so on. And that earned me the opportunity to manage much larger amounts of money. And then I moved more onto the mutual fund side in the early 1990s, which is what I'm primarily known for as a money manager in Canada, is mutual funds. Although I've run, a variety of different accounts over time. And then back in 2013, the firm that I was with got bought out. And then I had a choice of what I wanted to do subsequent to that. And I decided to concentrate on managing my own account. And then from that, I grew to begin writing the Global Investment Letter, which was a bit of an outgrowth of my own habit that I had developed over time about keeping a trading and investing journal. Because I found that when I was in school, one of the best ways that I could retain something to, in terms of studying for an exam, was actually to physically write something down. And then it would sort of stick in my mind. And so I developed over the years sort of a bit of a habit to try and just collect my thoughts on paper and try and work out, a plan going forward and so on. And so that's ultimately what the Global Investment Letter has become, is that I've kind of shared my own thoughts on a monthly basis about the market. And it's, I guess mainly it's an effort for me to give back a little bit to people in terms of perhaps getting the benefit of the hard won, and I underline hard won experience that I have, and so that's what the Global Investment Letter is. I talk about the positions that I have in the market, but also how I manage the trades and so on. And I'm not suggesting that people buy or sell what I'm doing. The idea is just to perhaps just give some thought to sort of how to actually undertake the task. And of course, I also talk about market conditions and so on. I guess one of the things is, as I said at the outset, my style has evolved considerably over the years from being a pure value to being now what I call a pragmatic investor in terms of incorporating value as well as technical analysis. And there's a large component of monitoring psychology, not only the market psychology, but also my own psychology as a human being. Because it's the old saying from a cartoon, I guess, I have seen the enemy and he is us. Well, one of my fundamental beliefs is the greatest obstacle that we have to being successful traders or investors is ourselves and our own human psychology. And so as an outgrowth of that, I've incorporated just a whole mishmash in a way of disciplines, which I kind of think of now as just being pragmatic. I kind of do what works. And over time, I have managed to, learn from my experiences. So my mistakes are, a bit less than they were when I was younger, and hopefully of a lesser scale. But they certainly still occur. So.
Interesting, and I guess from the audience's point, view on just what we're talking about, the Global Investment Letter is a bit more than a letter. It's 29 pages, in the last edition, of really thought-provoking, depth, and certainly we've all come from the pro world. It's a professional piece of work. It's what you'd expect to get out of a research team.
Yeah. Oh yeah, no. It's I don't want to make. Yeah, no. I mean, I guess I don't want to sort of. Yeah, I don't want to sort of understate it in a way. I mean, it would be considered institutional quality stuff,
yeah.
And I do. Besides just talking about my own sort of, trade management, like the recent issue, I did a kind of a deep dive on my thoughts about the prospects for inflation and so on. And I monitor what I think are the key elements affecting markets from around the world. Like, I began talking about the coronavirus last year in the February issue of the Global Investment Letter, and then I did a much bigger piece suggesting that equity markets were in danger, and those issues are actually up on the website as available as free sample issues. So yeah, I mean, I don't want to. I mean, I work very hard to make it a thoughtful, worthwhile piece for subscribers. Because I do charge a little bit for the subscription, and I want to make sure that people that are been kind enough to subscribe more than get their money's worth out of it. So
I think that underlines great process, though, to be able to curate that information and be aware of that information and to be tuned into those various verticals that are out there in markets. It goes back to what we talk about on the Alpha Mind podcast, that the process becomes important. Where you monitor, how you monitor, how often you monitor, what do you notice to be able to drive your decision is super important.
Absolutely, and the issue comes out once a month, and as you say, it's typically 29 or 30 pages. But I'm working on it every day in some respect for a few hours in terms of seeking out the information and considering what's going on and so on. So it's a lot of hours and a lot of effort, not only for myself but for my my team that helps edit my so it becomes a relatively polished publication, and at least in terms of the quality of the prose and so on. And we live in such unprecedented times. And that's easy to say, because the markets are always throwing up changes and shocks and so on. But what's happened since the turn of the century, in the space of 20 years, is remarkable. I guess the only way I could describe it. And the demands on an investor or a trader to be able to adapt to changing circumstances and to adapt to developments that are not intuitive. Like, there's been so much that has occurred, over the last 20 years that is actually counterintuitive from previous experience. One example would be, the expectations back coming out of the 2008 financial crisis that we were going to see a rebound in inflationary pressure because of the massive expansion of the monetary base. Well, ultimately did not occur. And I was one of those people back then that thought, well, based on former precedent, this is likely. It did not occur. And it took me a little while to figure out that spoke to the underlying weakness of the global economy. And I think we're in a similar situation now, where there are two camps. One that is expecting some widespread inflation coming out of the events of the past year or so, And other people, and I'm in that camp, is seeing that the inflationary effects are probably temporary and will ease back. But the challenges from a psychological standpoint for traders and investors are, I would say, more demanding now than certainly any time that I've, since I've been, actively engaged in the investing world. And that's what makes, the work that you and Stephen do and other people involved in considering the psychological elements of the market so important.
Yeah, no, thank you for that. I think the challenges that are in front of all of us, disappointments and risks and whatnot, extend far beyond the trading world. And of course, so the management of all of that bandwidth of things that can get in your way, ultimately leads to how good a trader you're going to be. If you're not managing it, if you're not picking up those triggers and dealing with those triggers appropriately, or getting tripped up by those triggers per se, it will feed through as to how you come through as a trader. So the psychology of the trader, I think, is it's constantly compromised in this debate about, well, where is the market going? And I think, as you say, back in 2008, there were 2 or 3 views, and some were right and some were very, very wrong. At the moment, there's not a consistent view. There are some people think about macro stuff and that lead through to inflation. There are some people that are looking at other topics that are coming through as new drivers, so sort of the climate side and the dispersal of populations and all sorts of things. The themes do change. You talked about psychology of traders, but earlier on in the discussion, you talked about monitoring the psychology of the market per se. Perhaps you can talk more about that.
Yeah. Well, I think, at the end of the day, and as I say, I'm constantly evolving, and probably, as a investor and a trader, and certainly one thing that I has grown more and more important in my thinking over the years has been respecting the sentiment that is about in the markets, and I think I've reached a stage now where I think it's pretty well axiomatic that one of the best ways of earning a good risk reward return in markets is to do the opposite of what extremes of sentiment are indicating. So, when everyone, the old saying is, whenever there's blood in the streets, you buy, and when everyone thinks things are wonderful, you sell. And while there's obviously more to it than that, if you can identify extremes in measurement in anything, anything that is an extreme reading, regardless of what it is, and this is almost something you could apply, in almost any aspect of life, is worth noting. It doesn't always meaning it's going to be decisive in terms of decision making, but when you're looking at extremes, that's worth considering and potentially acting upon. And clearly, we're living at a time right now where investor sentiment is at very elevated levels. You've got record levels of margin debt. You've got record levels of retail call option buying. I put out earlier this year a couple of posts of just magazine covers talking about the roaring 2020s. These are all none of these things occur at market bottoms, I guess is the best way to put it. And so I look at that, and I look at the dynamics of crowd of crowd thinking, which is what drives markets. And one of the most famous books on investing that I got exposed to, early in my career was Extraordinary Popular Delusions and the Madness of Crowds. And it was written in the mid-19th century. So for modern readers are going to have to excuse a certain amount of sexism and jingoism in the prose, but the sentiment is the same, is that the crowds of people will end up doing things that a reflective individual would never consider doing. And certainly, I guess we see that in the political history of the world, where countries and parties will end up acting in a way that makes you wonder, with the benefit of hindsight. So that has become sentiment has become a major factor in my consideration of markets and so on. But then I overlay that with fundamental considerations and technical analysis, and I guess at the end of the day as well, each of us have to find our own ways in the market. And I'm a big reader, and there was a couple of books written in the 1960s by George Goodman, whose nom de plume was Adam Smith, which I quite enjoyed. And I believe it's in one of those books where this quote that I remember to this day is, "If you don't know who you are, the stock market is an expensive place to find out." And I think that's a very telling observation. And so we all must come to our own, role as an investor or a trader. And for instance, myself, I just psychologically, or my personality would not lend itself to day trading. I'm not one of those people that sort of gets enthused with cryptocurrencies. Now, perhaps that's a function of my age, or, there's some very bright people that think they're going to, be the future. My own view is, if Bitcoin goes to $1 million, I think that's great. I'm more concerned about, how the investments that I'm involved in are doing, as opposed to things that I'm not involved in. So I guess that touches on another, concept of fear of missing out. People creating anxiety for themselves because, well, I didn't get that one, or geez, if I had bought this, And the other thing I've learned as well is, investment opportunities are, kind of like buses. If you wait a while, another one's going to come along. And sometimes you have to wait a bit longer for one to arrive. And sometimes you'll get 2 or 3 buses show up at the same time. So, I guess, I draw a lot of analogies to investing from other aspects of life. Because I get, partly because I think it's probably apt, and also because I've been doing this so long that it's become such a central part of my life that I tend to see things in many respects, through the lens of an investor. And so that, that probably has an influence as well. Anyway, to me, the whole investment / trading process, it's kind of a bit of a continuum. And it's, as I say, it just, I tend to see things through a certain lens. I guess being a professional investor, I probably produced that, but I've been doing it so long now.
We will return to the podcast shortly. First, a quick word about our podcast sponsor. This podcast is sponsored by the Society of Technical Analysts, the STA. We are delighted to be able to promote their brilliant STA Technical Analysis Home Study course. Listeners to the Alpha Mind podcast interested in studying for the Home Study course can get an exclusive discount by visiting the Alpha Mind blog page, where they can find a link to the Home Study course at the top of the page. Go to alphamindblog.blogspot.com or just Google Alpha Mind blog. Now back to this week's podcast.
I think it's important to understand that asking the reason why is, why am I doing this? Why am I trading? Why am I getting involved in this is super important. But also I wanted to this concept that people must have felt pain by coming in without asking the question why, just by joining a fad or like crypto. And there's a lot of people out there who would have felt pain and had to deal with pain. So it's a question, Jonathan, I want to throw your way about, you must have had periods where you felt pain in your career as a trader. Perhaps you can just go through some of those experiences and perhaps how you dealt with that, perhaps what that translated. What does pain translate into? How does it feel for you?
Well, thank you, Mark, for bringing that up, because that is a very important point. I mean, you were kind enough at the introduction to mention some of the successes I've had in my career, but that did not come without stress and temporary setbacks and so on along the way. And for me, one of the issues for me was dealing with changing markets. Markets have changed considerably since the mid '80s when I first got involved, and certainly, and the change started to accelerate in the 1990s. You had the dotcom bubble in the '90s and so on, and that was I remember that distinctly being a very difficult time for me, because while I like to think of myself as being able to adapt, it was very difficult for me to reconcile the valuations that some of the leading stocks were being priced at that time. And while I was making, I went through a period in the very late 90s that while I was making, in absolute terms, a very good return, I was not earning the same return as some other managers who had fully embraced the dot-com bubble. And being in the mutual fund space, performance is a big consideration. So it was very painful and stressful for me dealing with that. In retrospect, I managed it the best way I could, although, with the benefit of hindsight, I would have just gone all in. But my respect for risk, which probably comes from my start as a value investor, has always prompted me to look at investing in terms of risk and reward. And so in retrospect, I was quite happy that I, with the way I handled things, but it was very, very emotionally hard for me in those days, wrestling with those conditions in particular. I think I'd make the other observation too, that because my style has evolved over time, and it's evolved in response to the changing in the changing tone of the markets, that the evolution itself has created at least short periods where perhaps I've taken a step back in terms of my returns or my approach until the evolution sort of is complete. I guess the best way to sort of analogy to come up with is, if you're a golfer and you decide you want to improve your swing, sometimes you have to basically break things down to such that you've got an entirely new swing. And then when you do that, sometimes you go backwards before you go forwards. And I used to play tennis when I was younger, and that was the same thing with tennis. If you're trying to improve your tennis game, sometimes you're going to make some changes in your game, and it's going to cause you maybe to lose some matches in the short term before you actually move forward. And I think part of the evolutionary process for me was that. They weren't always necessarily, sort of dramatic setbacks or whatever, but they certainly psychologically were demanding on me in terms of adapting to those changes, and also having, I suppose, the distance or so to be able to recognize that these changes that I'm making or incorporating new things that I've learned are going to work out over the long haul. And then, of course, the process and how do you deal with those feelings? And one of the things is that, if you're not feeling particularly confident as an investor, or you're not sure of what the market is telling you, just start trading smaller or don't trade at all. That's a lesson that, I broke that rule probably, a few times when I was younger, but it's one thing that I've come to respect is that, monitoring risk levels and so on is so important over time. And certainly your psychology should be, tied into sort of your exposure as an investor. So I'm always asking myself sort of how am I feeling these days? Am I feeling too confident or overconfident? Am I too sure of myself? Or am I unsure of myself because I don't have a plan going forward? And, in any of those instances, if I don't have sort of a moderate sort of middle of the road approach, if I have any kind of those extremes of emotions, I try and, pull back as an investor. And now, of course, that's easier said than done now for me because, I'm managing just my own account and then publishing the Global Investment Letter. But when I was, when I was managing mutual funds and so on, I didn't have the luxury of, having 0% cash. People don't pay you fees for holding cash for them. So, and that leads to another observation I might make, that it's actually probably easier being an individual investor as opposed to a professional investor, because an individual investor has the ability, if they want, to be out of the market, completely, if that is sort of what recommends itself. And whereas you don't have that luxury as a professional investor in most cases. Now, there are advantages to being professional in terms of access to information and so on. But, even that gap has narrowed considerably over the years as well. But that is, I must say that particularly in that internet, in the dotcom bubble period, I had some day, I'd go home at the end of the day and I'd be feeling pretty beat up because intellectually, I knew what was going on was nuts. But it went on, longer than anyone would have anticipated. And that was the most noteworthy, period for me. Now I've had, I've also, when I was younger, I've had, periods where said, I just made a mistake, through lack of experience or just, because I was just wrong. And I have these little short terms, geez, how did you do that? Or I'd violate one of my own rules, which, I guess as human beings, human beings are fallible, and I'm all too human. So, even to this day, I'm constantly sort of checking myself in terms of, what I know to be the solid principles that have worked. But I have to remind myself constantly. And that's probably for me, one of the benefits of writing the Global Investment Letter is that, it helps me. And I've even occasionally written that in the issues. I say, I'm reminding the reader, but I'm also reminding myself that this, you got to bear this in mind and so on. So the global, the newsletter is a bit of a sort of a check on myself. And I think I'm probably a better investor for writing it than if I didn't. From my own point of view, not even, it helps remind me of stuff.
Yeah, it looks like a release for you. This sort of the other side of you gets turning away from, the physical aspect of trading into just writing. And I think, and whilst you're writing about markets, just that process is a way of you just kind of stepping back a little, just reflecting, just curating, just one experience, giving something back, as you say, because you're giving something back as well. So there's a good feel-good side to the letter. And I think it's almost like it's part of your process and part of your process of self-management, of like your place where you go to just, play around with some creativity.
Well, you're absolutely right, Mark. And I've also, in fact, I was just thinking about it over the last couple of weeks, is that the tone of the newsletter has changed a little bit. It's a little bit less formal now than when I started. And it's more now, here I am, I'm just kind of sharing my thoughts in what I hope is a cogent way with the subscribers. And I'm also showing a bit, I think I'm showing a bit more of my personality in it without, I don't want to, it's not about me, it's about the markets. But at the same time, I think you're absolutely right. The tone has evolved a little bit, and it's much more kind of me sort of working things out, but also sharing things with the subscribers. And I guess and it's turned out to be it's turned out to be just sort of a wonderful thing to do. Although I must say, writing each issue is a bit like running the gauntlet, because I try and get it out a few days after the end of the month, and I work on sort of end of month weekly charts, and I sort of just go into a zone for 4 or 5 days where I'm not doing anything else, and I need to, at the end of it, when I put the issue to bed, I just got to go lie down or something, So, I have that once a month gauntlet thing. So.
It's good stress, right? It's good stress.
Absolutely. But, it's such a relief to put it to bed. And in a way, but I get, I'm sure I'm sure I get as much out of it as the subscribers. It's been a wonderful process. So,
but I just want to move on a bit from that. The concept of trading a portfolio of ideas, managing all sorts of different risks that might be simultaneous, might not be. But certainly from my experience, the people that looked at the non-standard, the people that looked at the edges of the market, perhaps the things that were slightly complex, that were slightly off the beaten track, And often people were spreading, the unusual against the unusual, and were finding great benefit in doing that. But is that something that you found, that exploiting the edges of, not going into where everyone is, but kind of looking at the peripheral?
Yeah, that you're absolutely right, and that in part just goes to what drew me into the investment business. It was not anything to do with financial considerations. It was because I just got a curiosity about the world, and I want to try and understand what's going on in the world and to make sense of it. And I thought the investment business would be a great way to sort of have a ringside seat to be able to see those events developing. And I'm a student of history and geopolitics and archaeology, and just I have a range of interests, and people might be surprised, but all of those things have at one point or another played a role in my investing decisions and process, and looking at and looking at historic precedent, which history and psychology are, psychology is the driver of the human experience. So, while psychology is important, from an investing trading standpoint, it's also been a big driver of human history and so on. And the other thing is that, people don't change. If there were psychiatrists around back in the days of ancient Rome, they'd be hearing about the same problems from people that they would be today, and so I look at those things, and looking at fringy things, I read a lot, which is reading is one of the things that I would say to anybody interested in investing, just read as much as you can, and not necessarily, focus just on the markets. Just try and develop a bit of a general knowledge of topics that, would be reasonably pertinent, but to me, that's an essential quality of an investor is to be a reader. And because I read widely, I came across the coronavirus very early last year when they started talking about this, this thing when it was still relatively contained to Wuhan, and so that that caught my attention because because I knew history. I was aware of the effects of the Spanish flu in 1918, 1919, and its potential effects. And that's what prompted me to write about that. And I first wrote about it in February, and then more so last March. And that was kind of, I guess some people might call that a fringy thing, but it became obviously a very central issue. And I was a little surprised that the markets did not react to it more quickly than they did. But obviously, when they did, eventually, it kind of the decline happened largely at once. And I guess as an aside, that also sort of addresses sort of the academic notions of efficient markets. Because when I went to business school, all the professors were big adherents to efficient markets. And then, of course, I was skeptical even then, but I certainly had the scales fall from my eye when I actually started managing money. And while markets are relatively efficient, they're not perfectly efficient by any means. And I think they never will be. And I think the reason markets will not be efficient is, once again, kind of what we're talking about here is the role of human psychology. That human psychology, even given perfect information, will not always produce a perfect interpretation of that information. And so you're going to get mispriced markets. And then when you add in the prospect of market euphorias or market panics, you get these abrupt changes in markets that produce great risks and great opportunities. So all of these things, all of these things that sort of I incorporate into my thinking. I'm sure I'm sure you know what I mean. That when you're an investor or / trader, you're kind of always on the clock. You're always sort of thinking about it at some level, and so I'm always attempting to accumulate information that way.
I think having a curious mindset, curiosity per se, is a great way of just behaving. Full stop. Being well read, being well traveled, learning from experiences, calling upon what happened in the past, and asking the question: Is this going to happen again? We can see great evidence of different types of cycles coming through. And of course, I was a great follower of cycles when I was back in the business. The Kondratiev cycles and the impact of solar cycles on certain types of behavior, all that stuff. And I think I was super curious, and I had great benefit from being involved in market and being involved with super big clients, and having the dialogue based around curiosity was driving the conversation. And I think this is about, when you're a trader, it's about your conversation between yourself and the market. Do you have a conversation? Or do you just go in and say, well, I think it's cheap, I'll buy it? But actually, if you've got a conversation about it and you're curious about it, and you see the market as this kind of, high definition, intuitive thing that's just going on, you've got to understand what it's about. And there are lots of different facets. And so quite a lot of it comes from history. I know that Doug Mackerman around at Sabatigo that I engage with quite often reflects on European history and quotes European history in modern day dialogue about how some of the things taking shape now have happened before, and how we can learn lessons from the past. And of course, that in a way, it's our own journeys, right? How can we learn from our own behavior in the past, and how that then leads to tweaks that we then modify, that then modifies our performance. And knowing that we can't perhaps modify it in one big bang go, we need to do it in steps and learn each step and test each step, and then have a process of building up to a change that has a meaningful impact. So I'm glad you mentioned curiosity. I don't think enough traders have it. Some people end up trading the same thing for their entire life, and I just think you've got to kind of step back and have a broadened awareness, because there could be different types of opportunities out there that are perhaps less stressful, more optimal in terms of the amount of risk to create a certain return. That's not looked at enough. Would you? And I'm sure you'd agree with that, because this has come from your conversation, but I don't think people are curious enough.
I think that's right, and I think that also touches on an aspect of trading and investing, is that it's not even all about the markets or money or whatever. The process of becoming a better trader or an investor, there are benefits just yourself as a person, because some of the qualities that will produce better investment returns are also just qualities that psychologically will just help us in our other facets of our lives.
Now, how would you deal with uncertainty?
Well, I think I wrote recently, or I thought recently, uncertainty. Well, I don't think that, the only things I'm certain of is, the proverbial death and taxes. I'm certain I love my wife, and I'm certain I love my late dear departed dog. But beyond that, I don't know too much that I'm certain about. And I don't think investors have the luxury of certainty. I think that I think what we have to deal with is a spectrum of probabilities. And one of the things that I've learned is a very valuable tool is to think in terms of probabilities. And I must say that when I was in school, when I was first exposed to statistics, I didn't take to it too well for whatever reason. But as time went on, I began to appreciate it more and more, particularly probability. And the idea is, I guess what I try and do is, in my thinking, is to line things up in such a way that I've got the odds in my favor. They're never going to be 100%. And but you put the odds in your favor as much as you can. I guess the other thing that probability teaches us is that even if you have the odds in your favor, you're going to run through a period where you'll go on a sort of a losing streak, and you'll have a series of negative outcomes, even though you've done everything right. And then there'll be periods where you'll go on these long winning streaks, which is all part of probability. And so, at the end of the day, I've evolved my thinking to that. I don't really care so much what percentage I'm right or I'm wrong. It's how much do I make when I'm right, and how little do I lose when I'm wrong. So, I do try, obviously I try and, be right as much as I can, but I don't, it doesn't bother me if, if a trade goes against me. What I try and do is just, minimize the potential losses. The thing that really, the thing that bothers me more is, if I don't understand why a trade went against me or whatever, then I've got to say, okay, well, I've got to sort of think, okay, what happened here? What did I miss? Occasionally, I'll do everything right, and the market just decides to go the other way. And you just have to say that's part of the life of being an investor / trader. Sometimes things are going to happen that way. And then that also goes back to, the idea of risk and reward and not exposing yourself overly much on individual positions and so on. So I guess if you're in our business, you have to kind of embrace uncertainty.
So, I understand that, triggering yourself out of a position with a stop, is clearly managing the risk in one way. But one of the things I often hear and people ask a lot is that, well, if I'm in a trade, how do I stay in that trade long enough for it to be an optimal trade? Because people get very itchy about suddenly something's in profit and they'll cut it too early, they won't run it. Do you have any advice around that for people?
Yeah, well, we're sort of the markets that we're seeing this year is a good example of that, because we talked about sentiment and so on. I've been basically bearish since the start of the year. However, I've got a bunch of open positions in the markets, which I write about, and because the markets have not provided me what I think of as a concrete sell signal, I've just stayed in there, and I've been able to capture the gains in the market this year, even though I have some real concerns about the sort of the current risk reward of the market. So I think I wrote in a recent issue where I've rarely been more bearish yet had better returns on the long side as in 2021. I think I think that's where the role of technical analysis can come in terms of looking at things like moving averages and important chart levels and so on. that I think are very helpful in attempting to spot changes of trends and so on. So I am, if I'm long something, I'm going to stay long until I see evidence of a change of trend. And that has not occurred, at least in the markets that I've been exposed to, that I'm long this year. And so I use that. One of the mistakes that people make is if they've made a bit of money, they'll get out too soon, as I think you were alluding to. And that's a realization that I think comes with experience and so on. But if you don't maximize your winners, you're going to get chewed up on your losses. So the idea is in baseball terms, you hit the home runs will make up for a lot of small losses. So it is important to stick with a trade until there's concrete evidence of a change of trend. And I have my own little sort of yardsticks that I talk about and stuff, and I do find that major points of support and resistance in terms of chart reading are worth paying attention to. And something that I've also used is that as positions get close to those chart points, the risk reward of entering a position gets reduced, because those chart points, whether support or resistance, often are, if they're major, important levels, they're often the point at which you'll see trends reverse and so on. So I want to try and get into a position early in a trend, after the trend has been established, but not after it's it's pushing up against potentially a reversal point.
Mm-hmm. So would you call some of your positions trades, or would you call some of them investments, or would you have would you have like a separate view as to how you treat a trade, and how do you distinguish between the two?
Yeah, most of the the position, most of my positions, I will hold for months, and sometimes even years. But some I will hold for like a day if it turns out that I'm wrong. So if I buy something on a breakout that I think looks compelling, but the breakout fails, I will terminate the trade very quickly. Other positions, I'll just hold. I will hold something that until there's evidence that the reason I bought it no longer exists. So my holding period tends to be fairly fluid, but that's me, and that's the way I look at things. Other people, depending on their personality and so on, may have a different attitude. Which touches on something that I think is important, is that it's very important to identify the time frame that you're working with when you're initiating a position or an investment. So if you're attempting to make a long-term investment, you may want to be a bit more tolerant of some volatility than if you were doing something shorter term. Myself, my investment approach is, particularly now that I'm just running my own money, is highly personal now. So I'm just doing what works for me. But I don't pretend that so necessarily applies to everybody. But I will say that one thing that I do want to touch on, and is the role of volatility. That along with sentiment, the sort of the study of volatility has become, an important aspect of my work. And over time, I was reading about volatility and the mean reverting nature of volatility, which I've come to really respect. And that mean reverting nature of volatility cuts across all time frames. And so when you have periods of constricted, very low volatility, ultimately that gets resolved into periods of very high volatility and vice versa. And you see that in all walks of life, not even just restricted to investing or trading. You see that constriction of volatility and expansion with solar flares. The sun's got a roughly 11-year solar cycle. Well, you'll see that constriction. And so, and as a student of history, you'll see periods of relative calm and then periods of great turmoil and so on. You had the last part of the 19th century in Europe was relatively quiet from the point of view of wars and so on. But then you had Germany and Britain sort of building up their navies, and then one thing led to another. You had an assassination in Sarajevo, and you had the First World War, and then you had the Second World War 20 years later. So you have these, in all aspects of life, you have these constrictions and these spikes of volatility. So one of the things I do look at is that, and that's something I look at. You can look on it on a daily chart, a weekly chart, a yearly chart, and some those constrictions and expansions of volatility are noteworthy, and it's good to bear in mind that they're mean reverting. And one of the chart of volatility of the past decade, the 20 teens, was an exceptionally low period on a decade-long basis for market volatility. And that's one of the reasons why I expect the 2020s to be actually quite a volatile, tumultuous decade for investors. That's one factor. Now, of course, the fact that we've got a mountain of debt and to my mind, deteriorating global geopolitics are other important catalysts for what I think, is likely to be volatility this decade. I do think that, the financial system of the world and so on is going to look a bit different by the end of the decade than it is now. I think at some point there's going to be another financial crisis that's going to produce some changes, and that might result in changes to currencies and debt, and at the end of the day, it's dangerous to try and look too far ahead. But my expectations are that this decade is going to be challenging for investors.
Well, on that note, perhaps we've been rattling on for a good hour or so, and it's been absolute delight to have you on, Jonathan. I think the curiosity, the commitment, the awareness, all these things come together with what you're producing in terms of the Global Investment Letter, but also your own strategies. The letter's a reflection of them, but of course you've got process and your own style that's come about. And I suppose there is a question to ask before we start to wrap up: is that if you reflect back 20 years, what would you give guidance to yourself 20 years ago? What would be the key message?
That's a very good question. I guess keep learning, trade smaller positions, always remember that, markets are going to throw up the unexpected. Just keep checking your own psychology and so on. I wish I had the ability to go back 40 years, Mark, and talk to myself from this vantage point. So I'd be a very, very dangerous man. So, but I don't have that luxury.
You'd have gone the tennis route. You'd have been a tennis pro or something.
Well, I tell you, there were times, there were times, particularly back in the 90s there, as I was saying, that, other avenues of endeavor looked a lot less stressful. Let's put it that way, So fantastic. Anyway, I just want to say it was lovely talking with you. I hope I didn't rattle on too much. It's such a big topic.
It's I guess step back and let you rattle, and I think it did a great job. Now listen, a lot of people will perhaps be wanting to follow you and find you. Where can they find you on the web, on Twitter, and perhaps even get in touch regarding your letter?
Okay. Well, I do. If people want to look at my profile on LinkedIn, it's Jonathan Baird, CFA. If you would like to look at some sample issues of the Global Investment Letter, you can visit the website, and that's globalinvestmentletter.com. And you can just click on sample issues. And if you leave your name and address, you'll get put on. I put out a weekly short email where I talk about, just sort of, just market comments. It's a short email once a week. And so you'll get put on the mailing list for that. Plus, there's probably 6 or 8 sample issues of the Global Investment Letter that you'll have access to from that.
Fantastic. Well, look, both Steve, Silent Steve, I know we had some technical issues in London, but he listened and he was sending me little WhatsApp things saying, "Hey, ask him this." So he was sort of he was here. Let's go say he was here.
Yeah, well, you know what? Thank you, and I'm sorry if I kind of rambled on a bit.
Well, listen, that it's about you as much as we're the conduit to very interesting people in the market, and you're very interesting for many reasons. And we wouldn't be doing our job if we did the talking. We want to inspire you to share more and to dive deeper into your world, and because the audience come on to listen to you. We just guide the conversation. So
yeah. Well, thanks. I hope I hope I provided something, that will be of interest to your listeners and so on.
100%. But anyway, so for the moment, I wish you well. Thanks very much again.
Thank you for listening to this week's Alpha Mind podcast. If you have enjoyed this podcast or any of our past podcasts, we would be delighted if you could rate the podcast on whichever service you use, or even better, leave a review. Thank you also to our podcast sponsor, the Society of Technical Analysts, the STA. You can go to technicalanalysts.com to find out more about their services and to explore becoming a member of the STA. As a reminder, at Alpha Mind, we focus on trader and investor personal growth and development. We offer coaching programs which are geared towards developing the key human, personal and behavioural skills that are so vital in helping people grow their performance and take their trading or investing to a higher level. Our clients come from a range of backgrounds from across the world. These include leading portfolio managers working at some of the world's largest hedge funds, asset management firms and sovereign wealth funds. We also work with investment banks and some of the world's largest commodity and energy trading businesses. Our clients also come from a myriad of other backgrounds, including family offices, proprietary trading firms, as well as many serious private retail traders. In addition to trade and investor coaching, our services extend to executive, leadership and team coaching with a specialist focus on financial markets, investment and risk businesses. To know more about our services, visit our webpage alpha-mind.net or email us info@alpha-mind.net or visit the Alpha Mind blog page for more contact information. If you would like to sign up for our regular newsletter, you can do so on the page link at the top of the Alpha Mind blog, and you can also listen to our podcast on our new Alpha Mind YouTube channel. Finally, you can follow us and connect with us on social media. We are active on LinkedIn in our own names, Stephen Goldstein and Mark Randall, or through the Alpha Mind group on LinkedIn, which has over 15,000 members. You can also follow us on Twitter. Our handles are Alpha Mind 101 and Alpha Mind 102. We wish you well, stay safe, and have a great week.